Hi, my name is Brad Rosley. I'm a certified financial planner. Thanks for tuning in to this version of Smart Money. Today we're going to talk about taxes and investments. Before I get going, I want to remind you to go ahead and subscribe to my page and my video, and there's also information on my website at fortunefinancialgroup.com as well. Taxes and capital gains, especially today, as we get into the month of October, you should know about investing, or why you shouldn't be investing in stock mutual funds. There's a hidden tax potentially waiting for you that you have no business having to pay. Most people do not understand how mutual fund taxation works. But if it's outside of your 401k or IRA, and the mutual fund pays a capital gain out to all their shareholders, whether they had a gain or loss personally or not, generally comes in November or December of that calendar year. You might want to know, well, if I don't have a gain in my investment, why could I be paying tax? Well, let me explain that. That's what the purpose of this video is here today. If a mutual fund is buying shares of stock, they're doing it over periods of years in most cases. And the investor who buys into the old mutual fund is buying the cost of those stocks from whenever the mutual fund actually bought them, not when they bought in. I bet you didn't know that. So what does that mean? Well, let's just keep it real simple. Let's pretend the only stock in the mutual fund was Apple. And the mutual fund management team bought Apple way back 8 years ago or so, when Apple was the equivalent of $10 a share. Now Apple's, let's call it $220 a share. And they decide that they need to sell some stock to pay out some redemptions by shareholders, because when people want their money out of the mutual funds, oftentimes the managers have to sell the holding in order to raise the capital. So the mutual fund that you bought in, when you bought in, Apple was at $220, and the mutual fund manager had to sell some stock, and they look at how much they paid for Apple versus what they sold it for. Well, if they bought it for 10 and they're selling it at 220, they had a massive capital gain. Well, at the end of the year, the money managers for the mutual funds, they have to net their gains against their losses. And if they come out with a net gain, which in that simple example, obviously they had a huge gain on the Apple stock sold, they have to, by rule, pass that gain on to their shareholders. So whether or not you were around to enjoy the benefit of that appreciation of the Apple stock or the stocks in their portfolio, you get stuck with a capital gain distribution that all shareholders get and have to declare that on your income tax return and pay tax on it at the capital gains tax rates. So be aware of that. There's a date that every fund uses as to, if you buy in by this date, you will get that capital gain if there is one. Well, the way the stock market's been going the last 10 years, there's a lot of capital gains in these mutual funds. Whether or not you participated in the growth of that mutual fund value or not, if you buy in now, you're going to be stuck paying the capital gains tax on those gains. I hope this makes sense to you. Please subscribe to my site. Feel free to ask me questions about it. I'm happy to refer the answers to you or get you to a CPA that can if I can't. But these are really important things you should know about before you take on a new stock mutual fund purchase. Thanks for listening. Have a great day.